elementary review of a broke company, a hypothesis of Chord Electronics' financial state. All my previous BS review videos have concentrated on a company's treatment of the consumer. ZMF Headphones is the only company so far that has excelled in both product and service. By remaining humble and true to their ideals, ZMS has maintained quality control over their products and offered a unique experience. Though still room for improvement, ZMF is a company that should be considered a benchmark. Chord, on the other hand, is a troublesome company. I had reviewed Chord and specifically the Mojo in my first BS review episode. Since then, several people have commented that Chord has cut the price of the Mojo to £300 in the UK, though those savings have not translated to the United States. I gave this little thought until one day I had an opportunity to ruminate. Why is Chord slashing the price? That seemed out of character for Chord, so I did some digging. And I found something interesting about Chord's financials. Before I go further, I must emphasize this analysis is based on the scant information available about Chord's financial status, what is, frankly, publicly available. A lot of this analysis is based on common sense conjecture as a result of reviewing the documents I found. I am not a financial advisor. I have never operated a large business. I do not understand corporate tax laws. But, as I hope to show you, one does not need to be a corporate bookkeeper to see some of the irregularities in Chord's financial status. I must also underscore this is not a journalistic piece. I am not a journalist. I have no intention of being one. It's too much like Miley Cyrus grinding on stage. I haven't sold my soul to that extent. I did not start a dialogue with Chord about their finances. I did not consult a corporate tax expert. Make of that what you will. However, I should also say that if Chord is so eager to be disingenuous and willing to lie to customers, watch my BS review for more information, then it really doesn't deserve the benefit of the doubt. Treating others with contempt is a two-edged sword. Chord has slashed at the consumer's wallet and lied to their faces about their product's capability. I think it's appropriate to look at publicly available financial information and reach some conclusions without Chord's input. Indeed, when initially researching for this video, I came across several hi-fi articles wherein Chord was idolized. Those publications spoke to John Franks, Chord's founder, about the company. All of those reviews spoke very highly of Chord and its management. It is uniquely disappointing to read these so-called reviewer articles and not see any meaningful information. None of the reviewers discussed Chord's financial state because those reviewers did not bother to take a look. Why would a company's finances be relevant to the audiophile community? Well, when a manufacturer claims it is going to put the best and most amazing components in a product, and that product is going to compete with other devices that cost $36,000, then it is relevant to see how much cash they have in the bank. If the bank account is low, the reviewer can reasonably ask why this company can buy and assemble expensive components when it has little money. You see, reviewers would have to know the company in and out. Those reviewers would then have to ask the tough questions. That, of course, would mean risking the special conspiratorial relationships the reviewers have with companies. But this channel is different. Let's take a look at Chord's financials. It will make sense in the end. Sit back. This is going to be a long ride. Chapter 1. The Apple Strikes Back. Apple Computers has a tumultuous history. Apple was close to failing in the mid-1990s. It was close to bankruptcy. It did not have innovative products in the pipeline. It would not survive the end of the century. So, Apple brought Steve Jobs back, and because of his leadership, and that is a statement I make emphatically, the company had a complete turnaround. Innovative products were, again, the ideal. User experience was the motto. Ease of use was the standard, and above everything was a veneer of excitement. Apple's future looked bright and promising. It is all true that Apple was doing quite poorly in the 1990s. Although there was some growth, it was offset by the losses to Windows and IBM clones. Indeed, around 1995, Apple had a steady decline in revenue and growth until Steve Jobs returned in 1997. He stabilized the money hemorrhage, streamlined the product offerings, and after 2001, helped the company achieve year-over-year growth. It appears that in 1997, the year Steve Jobs returned, Apple had a net negative growth of 28% and, frankly, lost money. But, of course, we know the story. As of 2018, Apple had a net profit of over $55 million. Oh, and they have $245 billion in cash on hand in the bank account. Impressive. Most impressive.
Impressive. Most impressive.
It's unfair to compare Chord Electronics to Apple. That's like comparing apples to a bunch of liars. No comparison at all. But I do think it's worth pointing out that the size of the company isn't as important as how they handle their finances. Apple was in dire straits. It was too big and cumbersome and unfocused when Steve Jobs came back. It was, by all accounts, very close to bankruptcy. Bad management and lack of innovation brought Apple to the brink of death. But with a more focused CEO, a product lineup that made sense and looked to the future, and customer service as the end goal, Apple was able to come out of that spiral. Apple didn't focus on getting into more debt during the turnaround period. It didn't buy up tons of components and stock its warehouses with computers released in 1995 and 1996. No, they liquidated everything that was holding them down, renegotiated contracts, terminated products that were a drain on the company, and steered the ship into the wind. Chord, however, seems to be in financial quagmire. Instead of innovating and treating customers with respect, it looks like Chord has chosen the path of idiocy. Chapter 2. Understanding the plethora of troubled waters.
Many piñatas?
Oh, yes, many.
Would you say I have a plethora of piñatas?
A what?
A plethora.
Oh, yes. You have a plethora.
If you don't know how to swim, you may see every wave as life-threatening. Those who can at least tread water will be able to survive a short topple over the side. In the same vein, it is impossible to understand financial jargon, especially tax information, unless you're either an expert or have some type of business background. Consequently, we must first understand the signs of financial trouble for a company. And since I do not own, operate, or understand the complexities of running a multi-million-dollar business, I must look to general guidance. Investopedia.com is a website that provides a plethora of information regarding financial investments and business advice in general. One article, updated in June 2019, is titled Warning Signs of a Company in Trouble. It is written by Glenn Curtis, who has over 12 years of investment experience. He provides general information regarding the signs of a company in financial difficulty. His information isn't a strict code, only a way to help explain some irregularities. Indeed, the premise of his article is to assist would-be investors with little experience understand when a company might be a poor investment choice. His article provides the following 8 pieces of information. Number 1. Dwindling cash or losses. Companies that lose cash fast can be in financial difficulty. You must compare the current cash flows and cash holdings with the same period in the year prior to see if there is a trend. Of course, a company may lose cash because it is reinventing. For example, Apple may purchase a smaller company for $400 million in 2019, thereby decreasing the overall cash holdings by that amount at the end of the year. This is an investment into the company's future. However, if the company in question is putting money into operating activities and still not earning a profit, that would be concerning. For example, if Apple makes no purchases of other businesses, does not build another server farm, and is only paying money to its employees, leases, taxes, etc., and is still losing money, then that would be a problem. That would mean Apple is not making enough money to cover its overall costs. Number 2. Interest payments in question. A company's income investment statement should show what it pays to service its debts. Can the company keep losing money and still have enough left over to make the interest payments? This can be somewhat difficult if the income statement is incomplete or some data is simply not available. In which case, you can determine the ability of a company to pay its debts by using a business ratio. Probably the simplest involves dividing the current assets by current liabilities. A higher ratio than the number 1 indicates a company that will have a high chance of being able to pay off debts. But a ratio of less than the number 1 will indicate that a company will likely not be able to pay off its debts. For example, if Apple has current assets of $100 million and has debts of $30 million, then dividing 100 by 30 will result in a ratio of 3.3. There is no doubt in this circumstance that Apple has sufficient capital to pay its debts. However, if the debt is significantly higher, say $200 million instead of $30 million, then the cash ratio is 0.5. You can see the problem in that situation even without the cash ratio system. A problem with this rough accounting is that current assets includes not only the cash in the bank, but everything that the company could possibly sell to make money. That includes a building it might own, stocks, and products waiting in the warehouse. This, of course, is not easily liquidated material. It is not very easy or fast to sell a building, especially if you're looking for a fair market price. Stocks might be difficult to sell immediately because selling more stocks might dilute the value of the stocks already in circulation, which, by the way, would make your current stockholders pretty upset. It might also not be an easy thing to just sell all your products at the warehouse. That takes time. It may involve slashing the MSRP, which would, again, cut into the overall profits that would be calculated in the cash ratio. The rule of thumb, therefore, is to have more cash in the bank than you need. The more cash, the better. Indeed, Apple has hundreds of billions of dollars in cash. It's their rainy day fund. I just call it showing off. Number 3. Switching auditors. At least in the United States, companies must have an outside auditing firm to make sure the accounting is accurate. If a company fires and rehires or hires a different various auditors over a short period without justification, that would be a sign of some turmoil. If Apple were cooking the books, so to speak, and its auditors weren't going to play along, then it would fire those people and hire someone eventually who would. Number 4. Cutting dividends. Dividends are payments to stockholders. When a company makes a profit, it will generally pay a dividend per stock held to the stockholders. This is a predetermined amount. However, if a company starts cutting the payments or defers payment, that might be a sign of problems. Imagine Apple can see that the cell phone business is going to slow down considerably. Apple also predicts that fewer people are buying new computers and won't buy a new computer for at least another year. That's a huge potential loss of profit. True, it has not happened yet, and it may never happen. But Apple wants to stay net positive in its accounting, meaning it wants money coming in to be more than the money going out to pay expenses. To guide the company through potentially bad times ahead for the next 2 years, Apple may decide to limit the dividends. Of course, doing something like this is considered a last resort. This is a clear giveaway that something bad is about to happen. It's like you're walking on the deck of the Titanic having a leisurely, pleasant stroll, and you see someone hurriedly filling one of the lifeboats with food and blankets. I think that might just tip you off. Number 5. Top management losses. When things are not going well for a company, senior members of management will leave or be fired. If this happens regularly, it shows at least turmoil behind the scenes and at worst, mismanagement. Further, elevating lower-level employees to management is a sign that the company either has no other qualified people or merely need individuals to fill vacancies without thought to actual leadership. Number 6. Big insider selling. If you see large shareholders suddenly dumping their shares, you know something is up. That's like the Titanic's lifeboats being lowered into the water. Now you really should be concerned. Number 7. Selling flagship products. Remember when I said it's a good idea to have more cash on hand than you'll need? If you've incurred large debts and can't grow the business, instead seem to be losing money, then you'll have to sell something fast. If you have a flagship product, that might be a quick way to make some money back. Cutting the price of that product and having a fire sale would be a dead giveaway. Remember HP? It used to make computers, then stopped, and then started to make computers again. They had certain financial problems in the 2000s. In 2013, they sold their tablets at steep discounts to make money, and indeed, they sold every last one of them. And then the company stopped making computers. And then they started making computers again after stabilizing their finances. Finally, number 8, cuts in perks. If a company offers health benefits, vacations, etc., then big cuts in those perks would be an indicator that the company cannot financially sustain such expenditures, or the company's new directors are very cheap. These are not specific rules that must be applied in every instance, nor must all 8 factors be met for someone to say that a company is in dire trouble. Nor is it wise to say that just one of these factors is enough to show that the company is doing badly. Indeed, it is perfectly normal for a company to have bumps along the way. A loss one year may rebound into a net profit the next. The loss of management may bring the appointment of better, more culturally attuned management. Indeed, that's what happened with Steve Jobs in 1997. Nevertheless, it would be foolhardy to say that these factors, if enough are present in a scenario, should be ignored. As for Chord, I cannot say that it meets all these criteria, but it does appear to meet 4 out of the 8. Chapter 3. Chord's financial statements. As I said in the beginning, I was a bit curious why Chord would sell the Mojo at a significant discount. I had not heard of a $300 Mojo being sold in the United States and assumed people were just talking about secondhand units. I went to pricespy.com and looked for a summary of Mojo prices in the UK. And it turned out, resellers were indeed selling the device at £299. I had the same result when I went to Chord's official resellers, those listed on Chord's website. This was perplexing. It seemed rather out of character for Chord. I can understand slashing a few dollars for a holiday sale, but $200? It's something else. Why such a big discount? It's safe to say that I'm a skeptical person. When someone says movie theater popcorn is the best, I roll my eyes and explain it's not so much the popcorn as it is their childhood recollections, the excitement of watching a movie, and all the environmental influences that make people think they like movie theater popcorn better than homemade popcorn. Also, I really like movie theater popcorn. Anyway, I wanted to know what was going on with Chord. A company that blatantly lies to customers is always prone to hiding something. And rest assured, I do mean to say that Chord Electronics is a deceitful company. It is a deceitful company. They lie. So, how do you figure out whether a liar is hiding something? Well, you have to go around them and see if they have any inconsistent statements. And of course, because this is Chord, inconsistencies were quite present. Let's start at the beginning. A. Loss of directors. Chord is a privately traded company registered in the United Kingdom. It is required to file yearly tax returns just like every other company. And those tax returns are available from government websites. Chord must file its financial statement with Companies House, a branch of the UK government that deals with corporations and registration of corporations. I went to the tax return database and found Chord's filings up to 2018. The database shows that Chord registered itself with Companies House in 1989. There are yearly filings, including continual changes in the management structure. For example, in Chord's early years, they assigned, reassigned, and reassigned different secretaries and directors. In December of 1998, Chord's then director Roger Cook resigned. John Franks, you may be familiar with him from my last BS review of Chord, and the founder of the company, became director shortly after Cook resigned. The 1999 and 2000 tax returns list Franks as director. Then, in March 2015, another director was appointed, someone named Matthew Bartlett. Then, in September 2017, another director was appointed. This one's name was Colin Pratt. A few more changes came and went for the designated company secretary, the last one having been appointed in December 2017. This may seem somewhat normal for a large corporation. Indeed, huge multi-million-dollar corporations have secretaries and subsecretaries and executive officers with assistant executive officers and so on and so forth. In large corporations, 1 or 2 changes every few years would be a statistical norm. People get old and tired, they buy out and retire, they move on to other, better jobs. But for a company like Chord, such numerous changes is a bit odd. Of course, that's reading into a near black void. You could imagine anything. It is entirely possible that all the replacements occurred because people got better jobs or simply were not interested in performing in their current positions. I can't imagine that being the company secretary is all that rewarding. But the numerous changes in the director's post is something quite unusual. A director is the equivalent of a CEO. Directors have principally the same powers and obligations. The only difference is that the person who directs a publicly traded company is called a CEO, and a privately held company calls that person a director. It seems somewhat irregular that so many changes to the director's office would happen so often. I could not find any information that would indicate there was something wrong with any of the prior directors. I have no information to say that Chord drove those people away. They may have been perfectly happy working at Chord and simply decided it was time to go. But there is a point at which such arguments become obvious excuses and not legitimate explanations. 1 or 2 directors leaving over the course of 30 years is not necessarily a sign of anything wrong. But Chord lost 4 directors in its recorded history and many more secretaries. What is equally confusing is that Matthew Bartlett and Colin Pratt, the 2 most recent directors, appear to have been from common stock. That is to say, their appointment letters designate their positions as rather run-of-the-mill. Bartlett's letter says that he was the production manager when appointed to director, and Pratt was the sales manager. It is possible I'm reading this incorrectly, but I can read. I am reading the words written on paper, and that's exactly what it says. B. Dwindling cash. This is where things start getting a bit weird. The goal of a company, whether publicly or privately owned, is to make money. That's the only reason companies exist. Yes, deliver a great product and all that, but we're talking about Chord here. It's about money. You want your cash to be secure in the bank, and you want to keep adding to it. You need to. You never know when something is going to happen: a recession, a sudden increase in price of electronic components, a renegotiation with your workers for increased pay or benefits, a sudden loss of interest in your product. Having a rainy day fund is absolutely important. Few can achieve the ridiculous cash stacks that Apple has, but a company that is purportedly doing excellently and makes the best hi-fi products around should at least increase their bank account, right? Let's take a look at Chord's cash. Chord's financial information dates back to the 1990s. We are not really concerned about the lengthy history. Instead, I am more intrigued by Chord's financial status leading up to the release of the Mojo. Why? Because John Franks and Rob Watts, the lead designer at Chord, chided John Darko to properly review the Mojo. Because Franks was adamant the Mojo was absolutely critical to Chord. The Mojo was released in 2015. So, let's take several steps back and look at Chord's finances, starting in 2019. I want to group this as 2 separate phases. Phase 1 will be the years 2009 to 2013. Phase 2 will be the years 2014 to 2018. In Phase 1, we will concentrate only on Chord's cash in the bank account, and its debts. In Phase 2, we will consider Chord's cash, debts, creditors, and stock valuations. This is because, as we shall see, the closer we get to the Mojo's release, the more relevant those additional items become. Phase 1, 2009 to 2013. I'm going to quickly work through the cash ratio, which requires you to divide the total current assets by the current liabilities. A number lower than 1 means a company is unlikely to pay its debts. A number greater than 1 means a company is likely to pay its debts. This measurement requires us to accept the company's valuation of their stocks, which, for a privately held corporation, is rather self-serving since they can say their stock is worth anything they want. All the physical items the company owns, again, accepting the value of those items as estimated by the company, and creditors who still have to pay the company. In 2009, Chord had, now wait for it, £890 in the bank. That's right, less than £900 at the end of 2009. In 2010, Chord had £1,403 in the bank. In 2011, that jumped up to £266,000 in the bank. In 2012, it fell just by a little bit to £2,210. In 2013, it rose a little bit to £6,053. Let's talk about the debt. In 2009, Chord had £438,490 of debt it had to pay in 1 year. In 2010, that fell just a little bit to $407,354. In 2011, that rose once again to $525,565. 2012, $260,838. 2013, $370,316. The total assets the company reported that it actually had, again, figuring off their own estimations, in 2009, £619,781. 2010, £536,013. 2011, $873,680. 2012, $477,415. 2013, £600,383 of total assets. What about the cash ratio? Dividing the total assets by the actual debt that the company has? In 2009, the cash ratio was 1.4. 2010, 1.3. 2011, 1.6. 2012, 1.8. And in 2013, 0.61. The problem with the cash ratio is that it's an estimate only, and it relies heavily upon the company's own purported wealth. A privately held company like Chord can easily inflate the value of its private stocks. It can put any value it wants on building it owns, the products it sells. In other words, Chord could claim its headquarters building would sell for $1 million, but in actuality, no one might buy that building for more than $800,000. In which case, Chord would have overestimated its total assets by $200,000. I think you could see how that might change the cash ratio estimation. Of significance is Chord's lack of control over its bank account. In 2009, Chord had less money in the bank than most high school students working a summer job. It is mind-boggling to see that Chord only had £890 in the bank, but had over £430,000 in debt. Chord's cash rose dramatically in 2011 when it had over £266,000 deposited, but the following year, in 2012, it lost nearly all of it and reduced their bank account to £2,200. I did the math. That is 99.1% decrease in money. Let me emphasize this. Chord lost 99% of its cash within 1 year. Since I am not a financial advisor, I cannot say as an expert that this is financial bankruptcy. But I am an expert in judging stupidity, and I judge Chord is financially retarded. Phase 2, 2014 to 2018. In 2014, Chord had 19,396 pounds in the bank. In 2015, they had 25,745. Also, in 2014, they had 485,737 pounds tied up in debtors, meaning people who owed Chord money. In 2015, that fell to 403,000 approximately. That's a difference of 84,000 pounds. In other words, Chord theoretically was paid over 84,000 pounds between 2014 and 2015, but the cash in the bank in 2015 only increased by 6,300 pounds. In 2014, Chord had 558,867 pounds subject to creditors, meaning that's how much was coming due within 1 year for Chord to pay. In 2015, that rose to 603,143 pounds, meaning Chord's debt increased 44,000 pounds within 1 year. In 2014, Chord had 344,997 pounds in stocks registered as assets, again, their valuation. In 2015, that rose to 412,000. The cash ratio turned out to be 1.5 for 2014 and 1.39 in 2015. The cash ratio isn't the end-all be-all, as I've said so many times already. Being a normal person not thinking in corporate terms, my brain goes immediately to the bank account. That, by the way, is problematic. In 2014, Chord had been a registered company for 25 years, and after 25 years, it had just over 19,000 pounds in the bank. Oh, and over 558,000 pounds in debts coming due within 1 year. That's a scary place to be, don't you think? Yes, I know Chord had over 485,000 pounds of debt owed to them as part of sales, but that money had not been paid. What had been paid in 2015 from the debts owed to Chord was a measly 84,000 pounds, but Chord's bank account grew only by 6,300 pounds, and its liabilities, money it owed to its own creditors, grew another 44,000 pounds year over year. Take a step back for a moment. This should raise a red flag if you watched my previous BS review on Chord. Remember in that video I spoke of John Darko and his discussions with Chord executives? If you don't remember or haven't watched that video, John Darko is a hi-fi reviewer who does very little to make his profession less scummy. He had an email conversation with John Franks and the chief designer at Chord, Rob Watts. Franks and Watts seemed very upset with Darko when Darko questioned the viability of the Mojo. Watts sent a rather antagonizing email to Darko, and Franks said about the Mojo, quote, "This is about the most important design we've ever developed." This conversation was sometime in 2015, when Chord had a laughable amount of cash in the bank and skyrocketing debt. Recall, I commented in that video, rather sarcastically I admit, that I was sure the Mojo was very important to Chord, that is, important to their financial bottom line. And it turns out, yeah, I was right. Chord was absolutely banking on the Mojo bringing in the money. They needed it. Badly. Like a meth addict needs his next fix. Like the United States Postal Service needs to lose my packages. Like Donald Trump needs to tweet while on the toilet. It's an uncontrollable urge. I mean, the tweeting. It all starts making sense now. 2014 and 2015 were hard years for Chord, it appears. I mean, 2009 and 2010 were pretty bad too. So was 2013, when Chord lost 99% of its money. Anyway, Chord was in deep shit, and they knew it. And they needed the Mojo to succeed. I've had a few people tell me that maybe it's time for me to move on from the Mojo since I'm clearly irritated by it. Please, let me assure you of this. It is not about the Mojo. It's about the company. I have a beef with Chord. Ever since I discovered they lied about the Mojo, they made a mediocre product appear outstanding, I was out for blood. So, no, I don't think my intent is to attack the Mojo's problems again. God knows it has plenty of them. No, the aim is to focus entirely on Chord. And there's so much upon which to focus. Let's continue our review of Chord's financials. Chord's 2016 tax returns show an interesting spike. At first glance, it might appear positive, but a breakdown and a careful reading of the financial filing shows something concerning. In 2015, Chord had 25,745 pounds in the bank. In 2016, that jumped up considerably to 504,000 pounds. In 2015, Chord had 403,253 pounds owed to them by resellers. In 2016, that increased to 461,892 pounds. In 2015, Chord owed 603,144 pounds to its own creditors. And in 2016, that spiked to 718,203 pounds that it owed to creditors and was coming due within 1 year. This was an increase of more than 100,000 pounds that they owed in debt. In 2015, Chord had 412,237 pounds in stocks, again reported by them. And in 2016, miraculously, the stock valuation rose to 1,076,385 pounds. Shocking. In 2015, the cash ratio we get is 1.39, and in 2016, the cash ratio is 1.54. Part of the problem with assessing the information contained in the public filing is that there is significant material unknown to us. The drastic increase in stock value is confusing. A publicly traded company can open new stocks quarterly. The sales of sudden new stocks can provide a temporary boost to the bank account. However, a privately held company does not have the benefit of immediate sales. You have to find a willing buyer for those stocks. In other words, a publicly traded company can merely tell its stockbroker that additional stock should be sold, and anyone who can afford the price can actually buy it. On the other hand, a privately held corporation has to negotiate with a singular person or a group and convince them to buy the stocks. Now, it may not be difficult if the company is well known and sought after. What is perplexing is the sheer number of additional stock valuation in 2016. See, in 2016, Chord stock rose 664,148 pounds within 1 year. It is unknown how much each stock costs. That is the benefit of keeping a corporation private. Very little has to be shared with others. We can try to guess a roundabout number for the stock price, however. For example, Apple's current stock price is $217 per stock. American Science and Engineering is a small publicly traded company that sells X-ray equipment. Its current stock price is approximately $37 per stock. Chord is free to value its stock at whatever it sees fit, and since they are Chord, it is entirely possible that their stocks are worth considerably more than most reasonable people would accept. However, it is probably safe to say that Chord's stock price is likely not valued close to Apple's price. Whether Chord would value the stock closer to American Science's valuation of $37 per stock is once again conjecture. Let us play with these two numbers nonetheless. At $217, Apple's price, Chord would have needed to sell 3,060 new stocks in order to make the additional 664,000 pounds in 2016. If valued at $37, American Science's price, the Chord would have needed to sell 17,949 additional stocks within 1 year. Although selling 3,060 stocks in a given year seems doable, selling it at the same price as Apple stock seems outrageous. Indeed, a potential buyer would need to be quite sure that Chord stock was worth at least as much as Apple's, a pill that is frankly hard to swallow without Chord's generous helping of marketing lubricant. Clearly, one cannot put anything past Chord's ability to lubricate. On the other hand, it is rather difficult also to believe that Chord would have been able to sell almost 18,000 stocks in 1 year. It is entirely possible that an angel investor purchased additional stocks. An angel investor is a wealthy person who provides significant funding to a small startup company in exchange for equity, but the key word here is startup. True, any wealthy hobnobber could decide to become an investor and purchase over 664,000 pounds of stock from Chord, but that would mean something difficult to accept. The angel investor would have majority control of Chord. You see, reviewing Chord's financials, an investor would have to be out of their mind to invest that much money without demanding majority control over the company. Chord, although profitable, is far from what it should be considering its 30-year lifespan. Furthermore, an investor would have to disregard Chord's rather dire cash swings year over year. An angel investor, however, would explain Chord's £100,000 increase in debt from 2015 to 2016. Chord may have used a portion of the investor's money to get further into debt. Always a good idea, I'm quite sure. My utter lack of corporate tax experience intact, I can draw only two possible answers about Chord's freakish monetary swing from 2015 to 2016. One or more investors, or two, inflated stock reevaluations coupled with additional funds obtained from sales. Let us now turn to the 2017 and 2018 tax filings to complete our data gathering. In 2017, Chord had £485,176 in the bank. In 2018, that fell to £367,085. That means Chord lost £120,000 from the bank in 1 year. In 2017, Chord itself was owed from resellers £491,874. In 2018, that spiked up to £1,436,895. In 2017, Chord owed to its own creditors £613,175. And in 2018, brace for it, Chord owed creditors £2,110,196. This was an immense swing of almost £1.5 million into additional debt within 1 year. And by the way, that's £2,110,196 of debt coming due within 2018. In 2017, Chord had £1,569,672 in stock valuation. And in 2018, it again miraculously rose to £3,617,992 of stock valuation. Chord's cash ratio for 2017 was 4.2. Hard to understand how. And Chord's cash ratio for 2018 was 2.5. Let us just get the issue of cash ratio out of the way. The cash ratio method uses the total assets as one of the two necessary terms of the equation. The total asset number is based on cash in the bank, fixed assets such as furniture and buildings owned, stocks, and sales that have not yet been paid to Chord. When one of these parameters is artificially inflated, the ratio begins showing inconsistent results year over year. It appears that Chord once again inflated the stock valuation, and once again, I have no information to determine how much each stock costs, who purchased additional stocks, or how many stocks are actually in circulation. It is evident, however, that without the significant increase in stock valuation, Chord's cash ratio would have been much lower in 2017 and 2018. Of more concern to the average person is the figure in the bank. How much cash do you have? Chord has struggled to push cash in the bank. It has erratically fluctuated. As of 2018, Chord's bank account is over £100,000 smaller than in 2017, and Chord's debts have increased by more than £1.5 million in 2018. Obviously, someone keeps giving Chord more credit, and Chord keeps running it. If there is one consistent trend with all these findings, it is that Chord simply cannot control its debt and cash flow. The odd stock increases is, well, rather odd. The loss of cash in the bank, on the other hand, is simply drastic. From 2009 till 2018, Chord's cash growth and shrinkage has been inconsistent. Since the Mojo was released, Chord has indeed maintained a bank account over £300,000, but it has not grown the account by much. Instead, Chord has dramatically grown its debts. I suspect most people would want to do the opposite, shrink the debt and grow the cash. You might say that this is normal for a company. I would argue, yes, it is indeed normal for a company mismanaged. For 30 years, Chord has been selling overpriced hi-fi products, and all the available tax filings demonstrate that Chord simply cannot break the £500,000 barrier. It is possible that Chord is investing in technology, material, and design for a new product. That might explain the rapidly growing debt. But that begs the question. Remember the tax filings from 2014 and 2015? Chord's bank account was dangerously low. C. Interest rates in question. Recall, we saw that a company should have sufficient assets to pay off its current debt. This is based upon the cash ratio. As we have now determined, Chord's cash ratio swings wildly year to year. And we have also found that Chord's assets are boosted by significant increases in inflated stock valuations. Without this stock increase, there is no doubt that the cash ratio would be far more troubling. Moreover, Chord's own estimation about how much its tangible property is worth should be looked at very skeptically. Just because Chord says its building, furniture, and products are worth a particular amount does not make it true. In fact, that number is likely to be inflated. Cash ratio is merely a number. It does not indicate positive or negative outlook by itself. However, in conjunction with dwindling cash reserves, materially increased debt, and no reasonable explanation for the rising stocks, I might be forgiven if I conclude that Chord is in the unlikely position to pay its debts, that is, without selling a majority of its assets. D. The Mojo fire sale. As I mentioned at the beginning, Chord is indeed selling the Mojo at a significant discount now, well, at least in the UK. We are told that when a company starts dumping its flagship product, that can be a sign of a company that is indeed in need of money immediately. The Mojo is not Chord's most expensive product, not by far, but it is certainly the one that sells more than the others. It is priced specifically so that the middle class could afford it. It is a flagship product in the sense that it would be easier to sell than the nearly $11,000 Chord Dave or the $2,700 Hugo 2. In other words, it appears that the Mojo's sale might be Chord's attempt to make money fast. Wanting to make money is not an indicator of anything wrong. If a company did not want to make money, that would be quite a surprise. However, the methods a company employs to make money are important for consideration. For example, if a company reduces prices by 10% for a holiday sale, that is a planned, anticipated price drop to take advantage of consumer spending at a specific time. People are more likely to spend money during Christmas. Consequently, companies invite them to spend it by offering slightly reduced prices during that time. Another reason would be to compete with some other manufacturer. Throughout a fiscal year, companies will plan slight price drops to undercut the competition to maximize sales by the end of their fiscal year. However, there are a few reasons that show that a company might be in financial trouble rather than just competing in a market. Let's take a look at Chord. Chord does not have any real competition. Indeed, it has priced itself out of the bracket for Chinese competition. Theo and Knob Sound happily sell products that are priced so low that if Chord tried to reduce its prices by that amount, the company might implode into a black hole. The timing of Chord's fire sale is rather odd too. There is no imminent large holiday. Christmas is several months away, and Thanksgiving is rarely the season where people give gifts. On the other hand, Black Friday, the day after Thanksgiving, and Cyber Monday, the Monday after Thanksgiving, are specific days when manufacturers reduce prices slightly to take advantage of a short period of increased consumer spending. It would make a lot of sense for Chord to have a large price cut for Black Friday or Cyber Monday or in December just before Christmas, but not now. I can think of only three possibilities. 1. Chord has a surplus of Mojos that is not selling. If this is the case, then it is evident that the Mojo was not the super amazing product Chord and its co-conspirators had claimed. Despite some audiophile assertions that the Mojo is a product everyone should own, people did not rush out to buy one. That would mean that Chord overcalculated to their detriment. I guess it's not the first time that Chord has inflated itself. Number 2. Chord needs to make money fast. We spoke with Chord's roller coaster financials. The near bankruptcy bank account in 2009, 2010, 2013, and 14, and 2015 was a shocking revelation, at least for me. And the constant debt that Chord has gotten itself into since 2009 is also eye-opening. Indeed, in 2014, Chord owed approximately £559 to creditors, and in 2018, somehow they managed to increase that debt to £2.1 million that was coming due that year. Under this hypothesis, there are some parameters that can be taken for granted. For example, I think it is reasonable to assume that Chord cannot reduce the prices of its other products. The Hugo, Hugo 2, Hugo TT, the Dave, all those other items are priced at several $1,000s. Short of a significant price cut, say 50% or more, the vast majority of people will not consider buying any of those products. However, the Mojo is just within the grasp of the middle class. A price decrease of 40% is a rather large cut, which is exactly what Chord has done. The Mojo has been sold for £500 or $500 since its unceremonious birth. It is now £300, a decrease of 40%. Number 3. Chord is going to release a new product. When companies are about to release a new product to replace an older one, they will sell the old stock at a discount. This is a fast way to make money, though sometimes without a net profit. It is a guarantee to get the older product to consumers and keep the company relevant just before the newer product is introduced. It is possible that Chord is about to release a successor to the Mojo. To prepare the way, Chord might be trying to offload its current stock, but that begs the question, if people who are buying the Mojo are already purchasing the Mojo, why would they then turn around a few months later and buy a Mojo 2? They just spend the money on the Mojo 1. Each of these hypotheses has additional ramifications. If Chord is not selling enough units to the Mojo, then it is safe to say that Chord is not selling enough of its more expensive products to fill the gap. A company's inability to sell products may not be the company's fault. A market recession, lack of interest in the type of product, negative reviews, and insufficient marketing could all contribute to the lack of sales. But that is not the situation here, I think. There is no recession in the United Kingdom or the United States. The audiophile community will always show interest. The average person, the person who spends time working and engaging with others and not watching headphone reviews, is unlikely to buy an audiophile product, especially at the cost of hundreds of dollars. It is also clear that there are a few negative reviews of the Mojo or Chord. The overwhelming majority of reviewers claim the Mojo is outstanding. Finally, Chord's co-conspirators have done a splendid job of hyping the company and the Mojo. So, if those factors are unlikely to have caused the slow Mojo sales, what did? I believe it might be the hype and subsequent discovery that the Mojo is not the $60,000 reference DAC that Rob Watts, Chord's designer, claimed it was. People could be unhappy, and their word of mouth would make others hesitant to buy the Mojo, especially at £500. Next, we should consider the hypothesis that Chord simply needs to make cash fast. Chord's financials are troublesome. Their inconsistent numbers and skyrocketing debt is surprising. At £2.1 million in debt, most of it coming due within 1 year, Chord will struggle to make interest payments, let alone pay off the debt. Yes, it has total assets that could meet the debt. They have over £1 million of proceeds waiting payment from resellers. They have millions in stocks. They have their fixed assets such as building, furniture, machinery, etc. But, as I shall explain in the next chapter, this is a faulty calculation. For purposes of this chapter, let us agree that Chord clearly needs ready cash. They need money to keep trickling in over the next several months. This could be to help pay for their debts. Finally, the last hypothesis, that Chord is selling the Mojo to make room for a new product. Of course, this is entirely possible. Chord's propensity towards secrecy and placing embargoes is now well understood. John Darko could at this very moment have the Mojo 2 and could be writing how the Mojo 2 sounds like the cotton candy filled with sweet honey drizzled upon a glazed donut undergoing an MRI scan. Good job, John. One can never really disregard this possibility since companies regularly release newer products so that the company can remain, relevant. Of all these hypotheses, this one is the simplest. It does not require people to make too many assumptions, does not require combing through Chord's financials, and does not require finding that the Mojo has a failed product market history. But we know that Chord's financials are abysmal. We know the Mojo isn't the spectacular product that hi-fi reviewers claim and some obstinate audiophiles assert. Therefore, this might be the occasion where the simplest answer may not be the correct answer. Or, It could be that all three hypotheses are equally correct, and Chord is in some deep shit. Chapter 4. Chord is seemingly in some deep shit. I have no concrete evidence to suggest that Chord is in deep shit, but I feel confident in hypothesizing based upon the publicly available information that Chord is likely in some deep financial shit. Let's take a step back and look at the big picture. Recall we talked about the cash ratio number. You divide the total assets by the total liabilities. A number over 1 is good, a number below 1 is bad. This is a rough estimate of how a company could, in theory, pay off its loans and debts should push come to shove. It is, however, not an accurate statement about the company's solvency. It merely indicates to potential creditors that they could recover their money if the company goes belly up. That would require putting a lien on assets, the building, furniture, products, and anything else the company had control over. The proceeds of any products sold after a default payment and placement of a lien would go to the lien holder. But no company wants to be in that position. Indeed, the goal of any company with competent management, really, this is a very low standard, is to keep the company self-sufficient. But we are not talking about the relationship Chord might have with creditors. Instead, we are more concerned about Chord's financial status as a whole. Let me put it in simple terms. Let us assume that you have 3 credit cards with a limit of $10,000 on each card. You have $3,000 credit limit left on each card. Consequently, you have $9,000 of credit available to use amongst the 3 cards, should you need to. But in your bank account, you only have $1,000 in cash. The fact that you could use the $9,000 waiting for you on your credit cards doesn't really sit well in your upset stomach when you realize you have such little money in the bank to begin with. Your cash in the bank account is not enough to pay off your credit card bills in one lump sum. Indeed, your paycheck is likely taking a huge kick in the nuts because you're paying the premium and interest on each credit card. Would you say that you're doing great financially? Let's not get lost in the corporate mumbo-jumbo. Corporate tax law is vague and full of loopholes. American corporations are notorious for making millions each year and paying no taxes. So clearly, the tax laws for us mere mortals is vastly different. I do not know anything about the tax laws in the UK, but I know how to read the numbers next to the word cash on a financial statement. And Chord's cash reserves are taking a deep cut. Recall, they had less than 900 pounds in the bank in 2009. Certainly, they have more than 367,000 pounds as of 2018. If you had that kind of cash in your bank, you'd be ecstatic. So that begs the question, is a company like Chord satisfied with that amount of cash in the bank? I assume they weren't particularly happy with their financial status in 2014 and 2015 when the Mojo came out. So in comparison, Chord should be proud of achieving a 1,735% increase in cash in the bank. Trust me, that is the actual increase. And they should be scared shitless too. You see, despite the nice influx of cash, Chord has managed to increase its debts to more than 2.1 million pounds. That is, Chord has almost 6 times more debt to pay off than it has cash in the bank. That should put things into perspective, yes? Oh, and let's talk about the assets while we're at it. Chord's most recent available statement shows it has more than 903,000 pounds of tangible assets, products waiting to ship, machinery, the building, any physical object that could be sold. Where does this number come from? Well, one of 2 ways. Either Chord paid an independent assessor to calculate the total fair market value of each of his tangible properties, or Chord gave its best estimate, what they think it is worth. For example, if Chord thinks that the CEO's desk is worth $10,000, that's what they'll put down in the equation. Of course, the desk might not be worth more than $2,000 given it the fair market value. But that wouldn't be the first time Chord has overinflated itself. Furthermore, tangible assets are not easy to liquidate. That is, they're not easy to sell to make money. Think about how long it takes you to sell something on eBay or Amazon or US Audio Mart. Yes, sometimes you get lucky and someone buys your listing within days, but in my experience, it takes months, sometimes years for a product to sell, even when my listing is the cheapest of them all. In the same vein, if Chord is having a hard time selling its products right now, how many people are tripping over themselves to spend $11,000 for the Chord Dave? Then how likely is it they'll sell a bunch within a short time? A steep discount on those products will help move a few more units, but never enough, and never fast enough to settle that upset tummy we were talking about. And all the fixtures, the CEO's desk, chairs, machinery, Chord's ego memorialized on a self-congratulatory statue, those are not going to sell for what Chord thinks. Nor will it be easy selling the building or larger items like big machinery. Any potential buyer of large office space will want to investigate any liens placed on the property, the condition of the property, the market value of the property, and then undercut that value as much as possible. The deal would require research, assessors, negotiations, contract, and yes, time. But what about the £1.4 million in debts owed to Chord by resellers? That's the cash owed to Chord. That's definitely money in the bank, isn't it? Well, yes and no. You see, for tax purposes, you have earned that money once the order is placed, even though you haven't been paid yet. You have to put that in your financial statement as an asset, even if not a single dollar has been paid to you. Why? Because the government assumes you're going to get that money eventually, maybe weeks or months later, but you have earned it. If your resellers choose not to pay you, you have a remedy by suing them in court and getting your money. The thing with the money owed to Chord is that in actuality, you don't know the payment schedule. For example, if resellers agree to pay quarterly a certain amount, then that's all Chord will get each quarter, no more and no less, no matter how much the resellers keep buying from Chord. Let me give you an example. Let's assume you make the world's best headphones. You don't sell them yourself, but you have resellers do it for you. You tell the resellers they can sell the headphones for $500, no more, no less. 10 resellers agreed to sell your headphones. It costs each reseller $400 to buy the headphones from you, because that's the cost to the reseller per headphone. And the reseller will make $100 off the sale at $500 to the consumer. Let us say that each reseller buys 500 units of these headphones, because they are the most bestest ever. 500 units at $400 per unit comes to $200,000 in cash that each reseller will have to pay. Resellers don't have that kind of cash available, so they agree with you that they will pay you $10,000 every quarter until the $200,000 is paid off. Each of your 10 resellers have the same deal, which means that each quarter you're making $100,000 from the resellers in total. Consequently, you would make a total of $400,000 every year from the reseller agreement. This, of course, does not include any taxes, import or export fees, or any other government sanctions against making a living. This is a very basic example. Chord's structure might be very different. Perhaps their payment schedule is more, maybe it is less. Let us take a concrete example from Chord. Look at Chord's 2016 filing and compare it to 2015. In 2015, Chord had approximately £25,000 in the bank. In 2016, they had more than £500,000 in the bank. Let us assume that each Mojo was sold for no less than £500. Let us also assume that each reseller had to pay £400 for each Mojo unit. How many units would have to be sold for Chord to make £475,000 influx in their bank account between 2015 and 2016? Well, divide 475,000 by 400. That comes out to just under 1,200 Mojos sold to resellers. That's quite a small number if you think about it. What does all this mean? First of all, it's a lot of conjecture. Second, with some logical assumptions, we can conclude that Chord isn't selling their products like warm bread at a French bakery. Third, it demonstrates that the total assets written in Chord's financials are not a true indicator of Chord's current financial solvency. Fourth, Chord's immense debt increase in the last 2 financial years, 2017 and 2018, is jaw-dropping. Recall, in 2017, Chord owed £613,000 to its creditors, 1 year later, in 2018, that increased by almost 3.5 times to £2,110,196 owed to creditors. Oh, and Chord's cash in the bank fell from £485,000 in 2017 to £367,000 in 2018. That is a 24% decrease. Let's go back to the simple bank account we spoke of earlier. Remember, we hypothesized having only $1,000 in the bank but $21,000 in debt from the 3 credit cards? Now imagine that debt increasing by 3.5 times to $73,500 and your bank account decreasing by 24% to $760. That would be the perfect time to panic, I think. Chapter 5. Everything is fine, don't worry. Hello, ladies and gentlemen. You may have noticed that the right wing of the airplane is partly torn off. I see no concern. We still have the other wing we can rely on, and there's still enough of a wing left on the right side. Thanks again for flying Chord Embargo Airlines. There will doubtless be Chord evangelists who will defend Chord to the extreme. Even in light of evidence that should give them pause and ask questions, those people will scream, shout, deride, and chastise anyone who would dare speak up against Chord. Those people are like televangelists. What's a televangelist? It's mostly an American phenomenon, though British have their own. A televangelist is someone who appears regularly on TV and claims to be religious. They tell you they have some secret knowledge and want to share it. They tell you nobody else can help. They say they have a bottle of holy water you can buy to bless your life. And they need your donations to keep spreading the good news of salvation. They proclaim that money should be no concern of yours, only euphoric afterlife. Remind you of any people? How about so-called audiophiles who remorselessly belittle those who speak up against disreputable hi-fi companies, or those who defend hi-fi companies to absurdity? I assume there will be some audiophiles who, upon watching even a small portion of this video, will exclaim that I am wrong, I know nothing, I have done no research, I have not bothered to be a journalist, and my conclusions are all wrong. Those people are fully entitled to those opinions. In fact, anyone not a televangelist would be entitled to think that my analysis is faulty. I could not blame you for that. But I would have to object if you disregarded the information in totality, if you made excuses for Chord's financial state. You may look at the financial statements and say that I misread them. That is certainly possible. Or you may agree that those statements say what I explained, but then you might argue that Chord is not in financial trouble. You and I are simply looking at the same information, little though it is, to try and make sense of it. You might rightly ask, why didn't I talk to Chord about this? Why didn't I reach out to them and get their side? Well, because I'm not a journalist. I owe Chord nothing, not a fair hearing, a right to speak, an opportunity to explain. I strongly stand by that position. Hi-fi companies are not weak. They take our money deceptively. And Chord is absolutely a deceptive company, as I have explained in the original BS review. Moreover, Chord has shown a propensity to lie. It is difficult to ask a known liar to make a statement, because you can't trust what they say. Whether or not Chord should have been given a chance to make a statement about this is irrelevant. It would not have altered my analysis. Why? Because Chord would have not responded, or Chord would have agreed that the financial filings are accurately written, or Chord would have said that I am utterly wrong and it is making plenty of money. Great. Without financial statements to contradict what we saw in the public statements, it would make no difference at all. In other words, I am not interested in Chord's bullshit, and neither should you be. If Chord is financially stable and I have misinterpreted the public filings, then so be it. Chord loses nothing. My opinion about Chord's lying, deceptive methods still stands. And I would not stop telling people about all of Chord's deceptiveness. But if I'm correct, if Chord has some financial problems, then that is of public interest. Why? Because we consumers need to be aware when we are about to buy into a company that may not be fiscally responsible, may not have the money necessary to provide further support, and may, if worse comes to worse, may not be able to sustain itself. Chapter 6. Why this matters. We are the little people. We apparently have no power. Hi-fi companies and their cronies in the hi-fi review world can push us around whenever they want. You should just take their word for everything because they know so much better. That's why companies like Chord and Astral and Kern blatantly lie about their products. Lie not once but over and over again. That's why such companies market heavily that they are the supreme overlords of sound quality. That's why audiophile reviewers are so conscientious and agree to strict embargoes and ignore the obvious faults with high-priced audio gear. That's why these audiophiles use colorful words to explain sound. Something sounds like cotton candy, floss candy, peppermint, think more MRI than X-ray. But if you know anything about me, you should expect me to laugh at such ridiculous statements. Hi-fi companies are snakes in the grass. They deserve to be treated with caution. And if it comes down to me or the snake, you can bet I won't hesitate to strike first. As for those so-called hi-fi reviewers, all their knowledge about sound and electronic components have clearly diminished their ability to speak and think. They are gutless, swindling, sniveling, yellow-bellied cowards. They don't deserve respect. They don't deserve to be treated with caution. No, they deserve to be treated with contempt and ridicule. I hold them in no higher regard than this. They are contemptuous swine. What matters is the consumer. People who pay for these products having been told one thing and then discover something quite different. We, the consumer, suffer for the audiophile bullshit claims. Well, I tell you, it is time to stop. These hi-fi companies need to be seen for what they are. Chord should not be given any quarter. They should not be allowed any benefit of the doubt. They have not earned the proverbial tab at the bar. I have been somewhat careful about my analysis about Chord's financial status. I am no expert. What I'm finding and assessing is based on common sense and some understanding of numbers. But I still have an opinion, and here it is. Chord is in financial disarray. There is nothing that shows this more than Chord's inexplicable debt and low bank account. In 2014, Chord had as much money in their bank account as the typical government employee or a manager at Applebee's. This, a company with 30 years history selling outrageously pricey products, this is all they had, £19,000 in the bank in 2014. Oh, and don't forget they had no money in 2009 when their bank account reflected less than £900. Yes, they have since then increased their bank account. And yes, for the past several years, that bank account has remained between £350,000 and £450,000. But the debt has not decreased. It has not remained stagnant. £2.1 million of debt coming due in 1 year is an incredible number. This could be chalked up to fiscal irresponsibility, that Chord doesn't know how to manage its checkbook. Or it could be to rising costs in doing business, but that's some serious cost increases. Either way, it shows incompetence. If you're too stupid to keep your debts low, you're too stupid to sell hi-fi products. If you're too dumb to find a different supply chain when costs rise, then you're too dumb to make a product. Why are Chord's financials of our concern? Because when we pay for a product, we expect reasonable customer service for the life of that product. Even when that product falls out of the warranty, we want to know that we can get excellent customer support if needed. Sure, a warranty may not cover the Mojo after 3 years, but we expect the customer service departments to still be available to answer questions. We expect Chord to follow the terms of its warranty. When we put down $500 for a product, we need assurance we can count on a company to service that product should something unfortunate happen during the warranty period. Indeed, if you spend the ludicrous prices Chord demands for its other product lineup, you better know that your $2,500 Hugo 2 will be serviced in case it breaks. There's a reason why people will typically grab the known brand merchandise before they think of buying the off-brand. We know the brand, trust that it has quality control, that has been around long enough to have a good reputation for customer satisfaction. Well, what happens when that name brand company starts hemorrhaging money? What's the first thing that goes? Customer support and quality control. Invariably, that's where the costs are cut. Do you remember Dell computers from the late 1990s and early 2000s? Their computers were, for a long time, among the cheapest and the worst made. Dell had an abysmal failure rate, and Dell's customer service, though adequate, was nothing to be proud of. Imagine the same with Chord. Over £2.1 million in debt, stagnant bank account, and decreasing sales, they have to cut the corners somewhere. When Chord says they have made their products with the best components no matter the cost, you can definitely call bullshit. Absolutely, costs will matter. When Chord's debt is over £2 million and its bank account is stagnant, they will in fact cut corners in the manufacturing process. We know that hi-fi companies as a rule lie about the quality of components. Chord said that the Mojo is a reference class DAC that competes with a $36,000 desktop reference DAC, but the Mojo has faulty hardware, bad batteries, and is not compatible with many portable devices. Imagine what the experience would be like if Chord could hardly pay its employees. Perhaps Chord can reasonably expect to have its resellers pay them huge sums of money in the next few years. And maybe Chord can erase a big chunk of their millions of debt. And maybe Chord will provide satisfying customer service for years. But Chord has not provided satisfactory customer service yet. Its products are overhyped, under-delivering units of audiophile candy floss bullshit. What can you do with all this information? Well, think twice before buying from Chord. Think whether Chord could provide the customer support you believe you deserve. Consider if Chord will continue to be a viable company in a few years. It's hard enough as it is to get Chord to replace a battery. Imagine how difficult it might be if Chord goes belly up. Instead of paying $100 for a battery for the Mojo, if Chord fails, then you could easily expect to pay double that. Well, because of scarcity. Conclusion. As hi-fi companies and their audiophile reviewer cronies continue to lie and deceive us, we need to become smarter and more aware. We need to anticipate potential problems with companies and make a reasoned decision if it is worth our money, frustration, and time to do business with those companies. You may say that none of this information matters to you. You might find that you can do business with Chord and are unpersuaded. Well, more power to you. But at least you have heard the information. Of some concern is that I have yet to find any other reviewer discuss Chord's finances. Is it because these so-called reviewers don't think it is important? Or because they don't pay attention? Or because they are too blinded by their audiophile farts of colorful metaphors? Or because it is in their best interest to turn the blind eye? Information is power. Once aware of the situation, you get to make the choice, and your choice has more impact. I will not tell you to put an embargo on embargo electronics. I would not tell you to avoid buying hi-fi products. But I will advise you that caution is appropriate. When walking through a field, it cannot hurt to keep your eyes and ears at attention. Those snakes in the grass could bite you if you're not cautious. If you enjoy this content, if you enjoy any of my other content, then please consider donating to me on Patreon. I have 6 very giving, generous patrons who give a little of their hard-earned money once a month, every month. With their support, I can keep this channel going. I ask that you as well consider helping. The reason I don't have to cater to audiophiles or companies is because, well, I think they can go jump off a bridge. I'm tired of the lying and the cheating. So, if you want more thorough, honest reviews, please think about supporting me by donating just a few dollars a month on Patreon. If you have any questions or comments, please leave them in the comment section below. If you have a request for a review, please use the review request form in the description below. Please follow the instructions and I will get to your review as quickly as I can. If you have not subscribed, then please consider subscribing. I love getting notifications every day that I have one new subscriber. I hope all of you have a wonderful, pleasant day.